Might be the Malaysian government have put in place measures such as strengthening our banking and also financial sector, so that it is actually that we learn from our previous financial crisis. So this actually have an effect where that means our market is not as bad as the others.
You know, I'm not an expert, of course, in the Malaysian economy, so I can't really comment on that directly. But it does seem to me that there are various ways various countries have tried to insulate themselves from the global economy. I'm particularly cognizant of some of the Chinese arrangements, a lot of currency controls and capital controls, which I think are related to some of the controls that Malaysia successfully used in the 97 and 98 crisis. And we're all looking with a great deal of interest at what happens in China. There seems to be a lot of pressure on China that the growth rates are dropping, although I don't know whether people are predicting that they might actually go negative and there might be a recession, but that the growth rates in China seem to be dropping. And I think that in Malaysia, what we've seen is that the volatilities don't seem to be as high, but the stock market still fell a lot. And it fell, but I think it fell over a longer period of time, so it didn't lead to as much volatility. And so what investors are always doing is trying to figure out what's the stock really worth relative to its future earnings. And perhaps what we're seeing in Malaysia is that that adjustment has pretty much taken place, that the Malaysian economy has whatever relations it has with its trading partners, which are very important because Malaysia exports goods all over the world. But if you make a forecast as to what's going to happen to trade, and you say, well, it looks like the stock market is 20% overvalued, and once it falls 20%, you can sit there with low volatility waiting for this recession to actually unfold. I think that there's going to be pain here as well. And I hope it's true that Malaysia has insulated itself from this global recession, but my guess is that it's going to have some amount of suffering, maybe less than its neighbors. Okay.
Hi, good morning, Professor Engle. My name is Ahmad Rafdi. Just got a few questions. I'm actually interested in quite some time in sovereign funds, which has become a major talk of the town in the US, especially for the past couple of years. Some economists argue that sovereign funds can create some instability in the macroeconomics, but at some point, I do see that the sovereign funds can contribute a lot, especially to the in terms of social benefits into the country. But what happened was that the sovereign funds that coming in from the oil-rich country, especially into the US, has been kind of controversial in the US, if I'm not mistaken, somewhere this year or last year. So can you please comment on your part on what is sovereign funds can bring to the US and also to the world, specifically?
I didn't get all of that. Did you say sovereign funds?
Yes, yes.
So what is the U.S. response to sovereign funds?
Some people in the U.S. are not very keen, especially those coming in from the oil-rich countries, because I thought that might taking away their sovereign and whatnot. So can you care to explain on that?
I just wanted to make sure I was answering what you asked. Yes, I think there is a mixed set of opinions on sovereign funds. We're very happy to have them come in and help support our banks when they're in trouble, but we don't want them to buy our ports because they might mismanage them or something like that. And I don't suppose that feeling is going to actually completely go away, because there is a concern about whether there is a political agenda associated with some of these purchases. On the other hand, you know, this is the way the world is, and if the U.S. is exporting all these dollars to buy petroleum, what we expect in return is that these dollars are going to come back and buy U.S. assets. That would be the natural thing. We're basically selling some part of American capital to pay for our oil. And so I think it's perfectly appropriate for these funds to buy U.S. assets. In many cases, I think it would be more attractive if they bought them in a more passive arrangement. So, for example, buy diversified portfolios rather than buying controlling interest in one company or another company, so that it would be less of a political issue. But I don't think there would be any issue, really, if a sovereign fund ended up owning a widely diversified portfolio of U.S. companies. And I'm sort of surprised, well, maybe they're doing that. I'm sort of surprised that's not the actual investment strategy, because it seems like that's the sensible one to do, and it's supported by economic theory. And in fact, most of the academic work says it's pretty hard to beat that kind of a portfolio.
I'm Rasha
Yes.
from University of Malaya. Prof. Engle, it's a great pleasure to have you here. I have two probably simple questions for you. Okay, based on your slides, you showed that you did make there's this kind of predictions on volatility for the 2008 based on the 2004 models there. So if we have done it in 2002, probably to 2004, how much has this information really been taken seriously before, you know, the 2008 Great Depression developed? That's number one. Number two is slightly more technical. I just want to know from your expertise, how much confidence do you have on the recent developments of arch models, for example, things like robust arch, robust gauge, and so on? Right, thank you.
So the first question is, was this 2004 date that I chose particularly important? And I think the answer is no. I think the parameters are pretty stable over time. But of course, the information that's incorporated every day is the recent past, as well as the parameters tell you how to weight the recent past. And so if the parameters are constant over time, then you weight the recent past in your forecast of future volatility every day going forward. And so it wouldn't really matter very much what period you estimated it up to. If you estimated it up through 2002, so you didn't have any of the low volatility period, it probably would mean that the volatility estimates were slightly higher, but I don't think you'd actually be able to detect the difference on this picture. There are lots of kinds of arch models. There are robust arch models. There are arch models that allow for time-varying skewness and kurtosis. There are models which have much more sophisticated versions of asymmetry in them. I think that whenever you look at a financial sector, you can find a best arch model for that sector, which won't always be the same. And so that there is room for better and better models of different sectors. On the other hand, the improvements are not large compared to going from no arch to an arch. So I'm not sure how much better financial decision making we would make by using the best model that anybody can find versus just a good model. I think that there are a couple of innovations which really are quite important. One is this asymmetric model, which I think is so dramatically supported by almost all asset classes except for exchange rates, which are more symmetrical. And the second is the fat-tailed error distributions, which may be what you're thinking about with the robust models, that the T and generalized exponential distribution tend to be much better representations for the data than the normal distribution, even though everything I showed you was actually a Gaussian likelihood model. But I think that there is continuing research in this direction. My personal feeling is that the most interesting questions now are, what are the economics of these volatility models? They're basically statistical models, but we want to know, how do they really work? What do they tell us about the economy? What are these news features that I've emphasized? What are the long-run risks that I've emphasized? How do those affect the volatility models that we estimate, and can we really see those features in the models? And you know, I think that's a pretty interesting set of things to investigate. Yeah.
Yes, good morning, Prof. I've recently watched a documentary video called Money Masters, and according to the video, that the global financial volatility, basically what is behind all this volatility is actually because of the group of bankers. And all this history has been starting from during the age of Rome, where all this money changes and start to come from the goldsmith. And now we have these modern bankers which they try to manipulate what we call the fractional reserve system, where they have they have limitless power, and they can manipulate the economy through this inflation and then deflations. I mean, that sort of theory, what is your comment on that? Thanks.
Well, I don't think I buy into that theory, but it's a very different tradition from the tradition that I think describes the world we see. I think that the financial sector, with all its failures and problems with banking and banks taking too much risk and so forth, I think this financial architecture, we should point out, has had enormous benefits for the global economy. I think if we look at the last decade, we see countries like India and China, which were very poor countries 10 years ago, now are major economic powers. Brazil has done dramatically. I think Southeast Asia has grown dramatically over this period. And in the US, the same thing has happened. And this famous subprime crisis actually is associated with loans that are given to low-income people to buy houses. So the question that I think we are faced with when we try to design global regulatory architecture is, how can we preserve the kinds of growth that we've achieved with these kinds of financial systems, venture capital that can find entrepreneurs in small corners of the earth, because the financial system is liberalized. How can we preserve those benefits without having the instability that we see today? And I think that requires a better regulatory architecture, but it doesn't really require such heavy regulation. It depends, I think, more on coordination and stabilization over the business cycle. So I'm optimistic that some of the new initiatives that are being proposed will, in fact, be able to walk this fine line between improved stability of the financial system without eliminating its benefits for the global economy.
Well, Professor, ladies and gentlemen, perhaps we can now accept the last question as we are coming to the end of the event. Thank you.
Thank you. With all this knowledge, Professor Robert, of tomorrow's market, I suspect you're a billionaire by now. If not, are you going to start a string of cafes in Asia? I mean, that might do it. How large is the American market compared to Malaysia's? How many times larger? 1,000 times? Or, do you know?
I don't know.
I just want to make a comment before I sit down. That is, right now we are in a high-risk period, as you would call it, because of two things. Firstly, we do not have, at this point in time, an action plan to deal with the present crisis. Secondly, we do not even have an action plan to create peace on this planet. The answer lies, quite appropriately, Dr. Moravec, in your name. You and we, working together as peoples of the planet, not races, not religions, not friends or arch foes, but as fellow human beings. And final comment is a flyer. I have a flyer here which says, I received this with the papers here only yesterday, prosperous times are back. Isn't that wonderful? It's McDonald. Thank you.
Well, I certainly agree with most of what you said. I do want to remind you that I am an academic also. I'm not a... Academics aren't billionaires. But I do think we need to plan for peace and financial stability. And it's a global problem, and I'm optimistic that the United States will be a full participant in this planning process going forward. I think that's something we have to look forward to. I don't think it's going to be an easy process, but I am looking forward to its happy resolution.
Thank you, Professor, for sharing with us your knowledge and expertise.
Good. Thank you.
Now I'd like to invite Yang Berbahagia Tan Sri Leo Mogi to present a memento to Professor Engle. Thank you, Yang Berbahagia Tan Sri and Professor. Distinguished guests, ladies and gentlemen, now we'll have a pleasant surprise for Professor Engle. Without further ado, I'd like to invite Ms. Chu from the Asia Pacific Brands Foundation to continue with the next event, which is a special award presentation by the Asia Pacific Brands Foundation to Professor Robert Fry Engle III in recognizing his contribution in the area of economic sciences.
Salam sejahtera. Yang Berbahagia Tan Sri Leo Mogi, Chairman of UNITEN, Yang Berbahagia Tan Sri Elias Omar, Chairman of the Asia Pacific Brands Foundation, Professor Robert Fry Engle III, Yang Berbahagia Professor Dr. Engineer Mashkuri Yaakob, Vice Chancellor of UNITEN, distinguished guests, ladies and gentlemen. The Asia Pacific Brands Foundation is a not-for-profit organization dedicated to the promotion and improvement of branding standards in Malaysia and the Asia Pacific. Its aim is to honor brand excellence aided by best practices and a strong brand culture. The APBF initiated the Brand Laureate Brand Personality Awards to outstanding individuals who have contributed significantly to the industries that they specialize in. Through their contributions, our lives and the world at large have been enriched. Outstanding individuals who have been conferred this award are Dr. Everett De Bono, the creator of lateral thinking, Dr. Myron Vance, the founder of Usana Health Sciences, Sir Cliff Richard, and in Malaysia, corporate captains such as Yang Berbahagia Tun Ahmad Saji, Chairman of Permodalan Nasional Berhad. Today, the APBF is pleased to confer the prestigious Brand Laureate Brand Personality Award to an illustrious gentleman in this hall. It is an honor for me to be given this opportunity to read the citation. Ladies and gentlemen, Robert Fry Engle III majored in physics and graduated with a master's in science from Cornell University. However, a small event happened in his senior year that would have great consequences. He decided to try introductory economics instead of taking one more elective in physics to finish his course. The introduction to economics was the catalyst that changed the course of his life, and he graduated with a PhD in economics from Cornell University in 1969. This was the start of a very enriching journey in the field of economics for Robert Fry Engle, culminating in winning the Nobel Laureate Prize for Economics in 2003 for developing methods of analyzing economic time series with time-varying volatility. Professor Robert Engle's background in mathematics and science proved invaluable as it enabled him to develop economic tools to analyze the unpredictable movements in financial market prices, interest rates, equities, bonds, and derivatives. The science fraternity lost a great son, but it was the gain of the financial and economic fraternities. In today's economic environment, Professor Engle's method of evaluation and forecasting of risks are crucial in helping to stabilize the financial market volatility. Ladies and gentlemen, today in this great hall, the Asia Pacific Brands Foundation, in collaboration with UNITEN, is honored to confer the Brand Laureate Brand Personality Award to Professor Robert Fry Engle III for his contributions in the field of economic sciences. In the same token, we hope that Professor Engle will be proud to receive this coveted and prestigious the Brand Laureate Brand Personality Award, another laureate to his prestigious Nobel Laureate Prize. Now, may I call upon Yang Berbahagia Tan Sri Leo Mogi, Chairman of UNITEN, and Professor Engineer Dr. Mashkuri Yaakob, Vice Chancellor of UNITEN, Yang Berbahagia Tan Sri Dr. Elias Omar, Chairman of the Asia Pacific Brands Foundation, and Dr. K.K. Johan, CEO of the Brand Laureate, to come on stage. Ladies and gentlemen, it is an honor for us to present the Brand Laureate Brand Personality Award to Professor Robert Fry Engle, and may we have Tan Sri Elias Omar, the Chairman of the Asia Pacific Brands Foundation, to present the award. May we have a round of applause for Professor Robert Fry Engle. And also, Tan Sri Leo Mogi to present the certificate to Professor Engle. A round of applause for the gentleman. And now we'll have Dr. K.K. Johan presenting the coffee table book to Tan Sri Leo Mogi. And a copy to Professor Robert Fry Engle. Ladies and gentlemen, the Brand Laureate Coffee Table Book is a documentation of all the winning brands that has received the Brand Laureate Awards in 2007 and 2008. Thank you. Now I'd like to pass the, thank you, gentlemen. Thank you. I'd like to pass the mic now back to Puan Zuraini.
Thank you, Ms. Chu. On behalf of UNITEN and Malaysians, I'd like to take this opportunity to congratulate Professor Robert Fry Engle III for being the proud recipient of the Brands Laureate Brands Personality Award. Distinguished guests, ladies and gentlemen, we have now concluded our lecture. On behalf of the organizing committee, we would like to thank Professor Robert Fry Engle III for his special presence and contribution to the event. We would also like to thank your kind cooperation throughout the event. For your information, the next Tun Mahathir lecture series will be held on the 8th of April 2009. The speaker is Professor George Fitzgerald Smoot, who is the director of the Berkeley Center for Cosmological Physics. He was awarded the 2006 Nobel Prize in Physics for the discovery of the black body form and anisotropy of the cosmic microwave background radiation. You're all cordially invited. Admission is free via online registration at www.uniten.edu.my. And here's a special announcement from the organizing committee. Ladies and gentlemen, before you leave, please complete the questionnaires given to you earlier and leave them on the chairs or pass them to our offices in the hall. Your cooperation and feedback will be most appreciated. Once again, thank you for your kind presence and support throughout the event.